So is the dollar still the best bet with all the issues taking place around the globe?
It's April 2026, and the dollar just had its worst start to a year in over half a century. The tariff war with China escalated to levels nobody thought were actually possible. 145% on Chinese imports. Markets didn't just wobble, they repriced everything. And here's what made it stranger. Usually when America causes economic chaos, the world panics and buys dollars. That's the pattern. That's always been the pattern. This time, they sold them. Foreign investors pulled money out of US assets. The euro surged, the yen surged. Even gold hit record after record. And for the first time in decades, serious analysts, not fringe economists, not BRICS propagandists, started asking out loud whether dollar dominance might actually be cracking. So, let me ask you something. If the country with the world's reserve currency is running $2 trillion annual deficits, has no AAA credit rating left, and just triggered the biggest trade war since the 1930s, why does the dollar still rule the world?
There's many signs to believe that the US dollar, which, has had a very, very nice run, is rising for, reasons that are very appealing compared to a lot of other countries around the world.
That's not a rhetorical question. The answer is genuinely fascinating, and it has almost nothing to do with America being strong. What we're living through right now is the most serious stress test the dollar system has faced since Bretton Woods collapsed in 1971. And yet, as of right now, the dollar is still the currency of roughly 58% of global reserves. Oil is still priced in it. Global debt is still denominated in it. When a company in Vietnam wants to buy machinery from Germany, they convert to dollars to do it. The question isn't whether the dollar is weakening. It clearly is. The question is why the architecture holding it up is so much harder to dismantle than the headlines suggest. To answer that, you need to understand three structural mechanics that don't make the evening news: the Petrodollar system, the SWIFT network, and the US Treasury market. Because these aren't just financial details. They are the reason every country that wants to move away from the dollar keeps running into the same wall. And understanding them will make you a more intelligent reader of every dollar story you see for the rest of this decade. In 1974, the US struck a deal with Saudi Arabia. America would provide military protection and security guarantees. Saudi Arabia, in return, would price all its oil exports in US dollars and park the profits back into US Treasury bonds. The rest of OPEC followed, and just like that, every country on Earth that wanted to buy oil, whether they were in Africa, Asia, or South America, suddenly needed US dollars to do it. This created something economists call structural demand. Not demand because the dollar is attractive, demand because the entire global energy system runs on it. Now, this system is under pressure. Saudi Arabia has started accepting yuan for some oil deals with China. Russia sells energy in rubles and rupees. The petrodollar's grip is loosening at the edges. But here's what the headlines miss. Oil is still overwhelmingly priced in dollars. The share of global energy trade settling in other currencies is still in the low single digits. The erosion is real, but it's slow. And it doesn't matter much unless the alternatives scale, which brings us to Pillar 2. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is the messaging system that moves money between banks across borders. It connects over 11,000 financial institutions in more than 200 countries. And it runs on dollars. When Russia was cut off from SWIFT in 2022, it was financial shock therapy. Russia scrambled to build workarounds, using China's CIPS system, bilateral barter arrangements, and crypto corridors. They managed. But it cost them enormously in friction, time, and discount rates on their exports. That episode proved something important in both directions. Yes, it showed the dollar and SWIFT can be weaponized. That spooked a lot of countries, including ones friendly to the West, into quietly exploring alternatives. But it also showed just how hard those alternatives are to use at scale. CIPS, China's competing system, handles a fraction of SWIFT's volume. It's growing, but it doesn't have the correspondent banking relationships, the legal frameworks, or the liquidity that makes SWIFT frictionless. Replacing financial infrastructure isn't like switching apps on your phone. It's like replacing the plumbing of every building in every city simultaneously. It takes decades, not headlines. This is the pillar that rarely gets enough attention. The US Treasury market is the deepest, most liquid financial market on Earth. We're talking about $27 trillion in outstanding government debt, and a daily trading volume that dwarfs every other sovereign bond market combined. What that means practically: if you're a central bank managing $500 billion in reserves, there is only one market in the world where you can park that money, move it quickly, and know you can get it back. That market is US Treasuries. China has US Treasuries. Japan has US Treasuries. Even countries with fraught relationships with Washington hold treasuries, because there's simply no equivalent alternative. The euro area's sovereign debt is fragmented across 20 countries, each with different credit ratings. China's capital markets are still partially closed. You can't freely move money in and out. Gold is too illiquid. Crypto is too volatile. This is the dollar's deepest moat. And it reinforces itself. The more countries hold treasuries, the more dollar-denominated transactions happen, the more demand there is for dollars, which keeps US borrowing costs lower, which sustains American fiscal capacity, which sustains the treasury market. It's a self-reinforcing loop that's extremely hard to exit from the outside. Let's be honest about the real risks. The dollar's share of global reserves has declined from about 71% in 2000 to roughly 58% today. That's a meaningful shift, and it's accelerating slightly. The BRICS Plus bloc, now including Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran alongside Brazil, Russia, India, China, and South Africa, represents enormous economic weight. Their push for a settlement currency or a commodity-backed alternative is real, not just rhetoric, and domestic US politics isn't helping. Trillion-dollar deficits year after year, political brinkmanship over the debt ceiling, and the Moody's downgrade all chip away at the credibility the dollar needs to maintain its premium status. Here's the nuance, though, and this is what the dollar collapse crowd consistently gets wrong. A currency doesn't need to be strong to be dominant. It needs to be the least bad option. Look at every realistic alternative. The euro. The EU doesn't have a unified treasury. The yuan. China controls capital flows too tightly for the world to trust it as a reserve. A BRICS currency, 5 countries with deeply different interests, inflation rates, and political systems haven't agreed on what to call it yet, let alone how to back it. The dollar is declining in relative terms, but relative to what is the key question? When China disappoints, when Europe stumbles, when emerging markets wobble, capital runs home, and home is still the dollar. That doesn't mean it's permanent. It means dethroning it requires a genuine rival, not just the desire for one. So, here's where we land. The dollar is not invincible. The cracks are real. The petrodollar is fraying, SWIFT is being stress-tested, and US fiscal credibility has taken genuine hits. In 2026, for the first time in a generation, markets didn't instinctively buy dollars when America caused the chaos. But the dollar survives not because America is unbeatable. It survives because the world built itself around it. And rebuilding takes generations, not summits. Every year there's a new headline about the dollar's death. Every year, in a crisis, the world buys dollars. Until there's a true alternative, liquid enough, open enough, and trusted enough to absorb global finance, that pattern holds. If you want to understand the other side of this story, how money is quietly fueling the US-Iran conflict behind the scenes, that video is linked right now. And if you're still wondering why BRICS's rise could reshape the global order, or how US debt keeps interest rates high across the world, watch those videos next, because none of these stories exist in isolation. They're all connected.